Good morning, everybody. Thank you very much for joining us today for our presentation titled It's Not About Timing the Market, but Time in the Market, where our Chief Investment Officer, James Penny. Just a little bit of housekeeping before we get this presentation underway. Underneath the presentation, you'll have a series of areas that you can help us with. We have a feedback section that we will be using to shape our future webcasts. The vote section will be where you can actually interact with votes throughout this presentation, the first of which will be for what you want the presenter James Penny to focus on during this presentation. Finally, there's a question section where you can send over questions for our presenter, which will be answered during our dedicated Q&A session towards the end. We've decided to do this as a series of webinars going forward to help keep you, the IFA community, updated, because we're currently living in unprecedented times, which have not only affected our day-to-day life and work routines, but have also taken a toll on the financial markets in ways that were not seen in the 2008 crisis even. With this in mind, we thought it would be timely to host this webinar and share some of our thoughts on how to best navigate this storm. This takes us on to today's presenter, James Penny. James joined TAM in 2014 with a wealth of industry experience working in both New York and London, specialising in global equities and derivatives. He now heads up TAM's investment committee, which is responsible for over 27 portfolios across 5 strategies. I'll now hand things over to James, but please, if you could vote on the areas that you'd like us to focus on, we'll then move forward with these for you. Many thanks. Over to you, James.
Morning, Joe.
Hello, James.
Hi, sorry about that. I got cut off.
No problem. Over to you.
Hi, thank you very much, ladies and gentlemen, for dialing in. My name is James Penny. I'm the Chief Investment Officer at TAM. Sorry for that little interlude. My internet's never as good as I want it to be. I want to start today by talking about the market in general. I want to talk about where we currently are. A lot of investors call me up asking to know about the trajectory of this market, not only where we've been, but where they think we're going. The main question that people ask, and it's a very, very good question, is, have we seen the bottom of this market? Nobody could answer that, because if people could answer that, then the market would react accordingly. What I want to do is break it down for you. The first slide I called Act 1, the viral bear. For the purposes of this presentation, I want you to think about this sell-off in 2 parts, like a play, Act 1 and Act 2. Act 1 I've called the viral bear, right? The reason I've called it the viral bear is because the sell-off from, let's say, circa 20th of February was very much viral induced. It was very much to do with fear around the pandemic. It was thousands dying, people dying in care homes. It was the National Guard on the streets. It was makeshift morgues being put up in certain areas. It was very much just panic around that drove the market lower. Yes, obviously, the ramifications of the economic impact were scaring investors, but not so much as the pandemic itself. So that's why I called it the viral bear. As you can see here, from around the 20th of February in both the all-share and the S&P, we've seen similar moves lower, in the order of about 35% from the peak to the trough. Since then, you can see we've had this bounce back in the order of kind of 21%. Now, anything over 20% is a rally, is considered a bull market rally. So if you want to think about it, we've gone from bull to bear back to bull again. And I think that signifies to me the end of Act 1, right? The market is starting to rally back. We're starting to maybe see a tentative peak in some of the infection rates in Italy and in Europe in general. Obviously, China. People think that the US and the UK maybe are around the corner. So the market's starting to get a little bit more sanguine about what drove the market lower in the first leg. So I think the indication that we're coming to the end of this Act 1 is seen in this rally back. Now, 21% is a pretty significant rally. The reason that we're talking about this is I do not believe that this bear market is over. I do believe that this is a bear market bounce. It's quite a big one, granted, but it's our perception that the market isn't fully pricing in some of the economic ramifications as a result of the virus. Just want to move on then to the second slide, which I've called Act 2, the economic bear. So Act 2, to our mind, to TAM, has not yet happened. This is the second leg lower. This is where the markets once again retest their lows. So that's, if we're 21% up from the bottom, to retest your lows you're going to need to come off by another 20% just to get back to where you were. Now, the reason I called it the economic bear is because the next leg is going to be very much driven by economic fundamentals. It's going to be potentially a relaxation in fear around the pandemic and the viral infection rates, and it's going to be more market driven, right? So it's going to be more, we can use past bear markets as a guide for this one, because it's going to be what people know. That's why I've said at the top there, the better the devil you know, because this sell-off is going to be in economics rather than in pandemics, which is something we've never really seen in our lifetime. But economic sell-offs, we've seen a lot of those. So far, the sell-off that we've currently seen is following, to an extent, the 2008 playbook. So what I've listed out here is the performance chart from 2008 to 2014. Now, I've put a red line there that says today ? Nobody's really sure, because this is 2008 that we're looking at here. But what I'm showing you is the performance in blue is the S&P 500. And as we can see, it kind of sells off in the initial stages, and then it rallies back, and then it sells off, and then it rallies back. Very similar to where we are at the moment. The thing that I want to draw attention to, which is why I think we're going to be in this, why we're going to retest the lows, is that gray line, right? That's earnings per share. That's 12-month forward earnings forecast for companies, right? Plain and simple, at the moment, the earnings forecast for companies are only 3% lower than where they were before this virus. So analysts believe that the impact in 12 months' time to company earnings is going to be 3% lower than where it currently is. Now, I don't know about you, but that seems very, very, very rosy, very optimistic. I've seen a lot of narrative, a lot of conversation from senior people in the market about the fact that this economic recession is going to be worse than 2008. 2008 had over 10% earnings downgrades. So what I want to draw attention to in this chart is when you start to see those earnings downgrades significantly come down, as the analysts start to adjust to their forecasts, you can see the stock market react pretty aggressively to that. So what we're trying to do here is illustrate the point that because these earnings downgrades have yet to happen, we have not yet seen the market react to that. If you look at 2008, when the earnings downgrades occurred, the market reacted quite significantly. So for this reason, combined with the fact that there's only been 3% cuts, maybe a little bit more now, granted, that data is a couple of weeks old, but it's not yet, the earnings downgrades have not yet come in the manner that we expect, and therefore we believe the market has not yet reacted to it. Listening to market commentators over the past 2-3 weeks, where we've seen this 21% rally, there's not a huge amount of conviction in its sustainability. There's a lot of people thinking that it was short covering, a lot of people thinking that it was this a lot of cash on the sidelines from investors pulling their money out that were very eager to put it back in, have potentially put it back in on the first sign of positivity. We believe that positivity is off the back of the viral element of this coming off. We don't believe the market's factored in the earnings downgrades yet. Very poignant that you're dialing into this presentation because the first earnings reporting for Q1 is today. The US banks are reporting their earnings today. It will be less about the earnings today because that will be Q1. And remember that Q1 had January and half of February of proper growth. So the numbers won't be too bad. What we're looking for is the earnings forecast for 12 months from here. That's what we're looking at. So we believe that over the next few weeks, as companies begin to give some guidance, the market will begin to react to this. And we don't believe that the 3% number currently priced in, or 4 or 5, is sustainable. We believe it has to come down. So again, the economic bear, because we believe that this next leg lower, the Act 2, not yet to happen, is going to be very much economics based, like 2008. And let's remember, in 2008, when the financial crisis occurred, a lot of economists said, we don't believe this is going to be a long-term hit to the economy. We don't believe this. We believe this is transitory. So we all know what happened in 2008 and 2009 and the recession that occurred. Investors this time around believe that it's going to be bigger than 2008. It doesn't tally that you've got 3% earnings downgrades when everyone's saying that it's going to be a bigger recession than 2008. So we're just being pragmatic here. Joe, I think you wanted to step in?
Yes, thanks, James. The results from the votes have overwhelmingly been in favour of you discussing the equity markets moving forward. So if you could do that, that'd be very much appreciated. We are having questions come in from the audience as well, which we will be answering at the end. I'm also going to launch another vote, which will be for any future webcasts that we're going to be putting forward. So if you could please go into some detail on the equity market, James, it'd be very much appreciated.
Sure, absolutely. Well, look, the presentation is very much geared towards using the equity market as a poster child for what's going to happen. So let's continue with the presentation because I think it answers that question. Now, where we go from here is a very interesting question. Have we found the bottom? Well, I think I've illustrated that we don't believe that we have found the bottom. Now, that might be worrying to some investors, but that is absolutely an opportunity. That's not a threat, that's an opportunity, because no one is talking about the fact that this market is going to keep going down in perpetuity. There will be a time when this market comes back. There will be a time when it starts to rally back. It's not a matter of if, but when. Now, what we need to do is we need to capture that market. If we believe the case that we've illustrated is going to take place, then we have an opportunity to buy some high quality assets at very good prices. So let's see how we do that. So that brings me nicely on to the topic of this presentation, which is time in the market or timing the market. First slide here is timing the market. Timing the market, as we all know, is sitting on the sidelines with a large allocation of cash or a small allocation of cash and looking at prices and index values and going, okay, I think now it's sold off too much. Let's invest what we've got. Whilst this is a strategy that does work on occasion and can generate you huge returns, it is fraught with risks and problems. And also, there's so many investors that have tried to do it and got their fingers burnt, so much so that there's a saying called catching a falling knife, which is essentially if you try and allocate capital after you believe the market is sold off fully and it continues to sell off, you catch a falling knife, it hurts, it cuts into your portfolio. And this is what I've put here, which is, again, this is the 2008 slide of the rally back to 2016. Now, if you just made an abject call, a subjective call on when to put your money back in, you might have bought at the top of the sell-off, you might have bought at the bottom of the sell-off, you might have bought after the rally back had done 15%. Because it's subjective, because it is up to you to make a decision about when to put that money in, Sometimes it's open to errors. Sometimes you might not make the full allocation of the rally back. We also believe that doing this doesn't have too much of a process. It's not a repeatable process. When we're investing clients' capital and we're stewards of capital, we need to make sure that the process we have is repeatable, it's understandable, and it's clear. That's essential for you and your clients, is for us to be able to explain how we do things, and more importantly, make sure that it's all repeatable. We're not a flash in the pan at TAM. We like to make sure that everything we do is backed up. So going on to what a better approach would be, rather than timing the market, it's time in the market. Now, what this slide is, I've taken the same chart from 2008 to the rally back, and instead, rather than saying, right, well, I believe the market's now sold off, let's get in, you're taking the sell-off, and at regular intervals, you are compounding and you're capturing that increased value. So at stages on the legs lower of the sell-off, you are buying, you're putting client capital into the market, right? So you're buying 4% lower, 3% lower, 4% lower. You're buying in and you're reallocating capital. So you're spending time in the market rather than sitting on the sidelines with your cash balance and waiting to put that all in. You are allocating it all the way down. Pound cost averaging is something that's similar to this. What this ensures is that, yes, you haven't bought at the very bottom, but what you've been doing is you've been buying quality, you've been buying your investment at ever increasing value. So when your market does rebound, you can compound that, you can capture that rebound fully because you've been investing all the way down, rather than potentially running the risk of not investing at the right time and either investing too early, all of your capital, or investing too late and missing some pretty heavy rallies. What I want to do is talk about those rallies back now, because research shows that if you miss a certain amount of days in the market of rallies, you can actually miss quite a lot of returns. So this chart is a simple one. It goes from 1996 to 2011. So that's 15 years of investing in the S&P 500. Now, the S&P index over that time made about 7.8%, not very much in 15 years. We lived through 2 bear markets in that time. So if you took an approach of timing the market and decided, right, now's the time to invest, now's the time to sell, now's the time to invest again, and you missed just 10 days, in 15 years of investing, you missed 10 days, your returns go down to 4.1. Miss the top 20 days, they go down to 1.7. This, again, with a strategy of just moving money in and moving money out, going into the market, out of the market, into the market, out of the market. If you miss those days, look at the returns. Even that, excluding the top 30 days, you're generating a negative return. Again, this goes against logical investing. Timing the market doesn't always work. In fact, a lot of investors get it very wrong. So what we're trying to show here. So I hope that's outlined a strategy that we believe it's not about timing the market, it's about time in the market. And not only that, it's a repeatable process that's understandable, that's explainable, and makes sense. If you're buying something that's high quality and it keeps selling off, you know the quality is not changing to an extent, right? Off the back of this corona-led sell-off, this coronavirus, yes, a lot of companies are going to be changing. Yes, a lot of companies' balance sheets are going to be at risk. It's up to us and our fund managers to establish what remains quality. And as long as we know what is going to be quality when the dust settles and it sells off by 4% and then sells off by another 4% and then sells off by another 4%, we can continue to capture that value all the way down. That's a repeatable and understandable process that everybody can get their head around. So what I've tried to explain so far is what's happened, where we think we're going, and what the right approach is for where that market is going, right? What the right approach is to capturing value in another economic-led sell-off. That's why I wanted to put here, don't panic when we think about what to do. The whole market is on the right saying we're doomed, we're doomed. Well, at the moment, with a 21% rally up from the low, a lot of people aren't saying that. We believe that they're going to. So our approach is not to panic. Our approach is to keep a repeatable process which looks at value, which looks at, we think, the best asset classes in the market and continue to buy them at ever attractive prices. That's it. We think that's a very pragmatic approach, and it's certainly not panicking, which a lot of investors were doing a few weeks ago. What I want to talk about here is, what is that? What is quality? What is quality in this market? Quality is a long-term company with very good balance sheets, long-term management, high barriers to entry. Their products are household names. They're not going anywhere. Now, there are many companies. I think we could all probably spend hours talking about what is quality, and these companies that have been around forever. Just looking at these two, you've got Unilever and Diageo are just two examples. And these go back to just 2000, right? So the last 20 years of markets, they go back a lot longer. These stocks have been around for a very long time. You can look at bear markets. You can look at 2008, and you can look at the small sell-off there in the bigger picture. This company is a quality company that continues to deliver long-term compounded returns for its clients. So every time you see a dramatic sell-off, you know that you're buying a good quality asset at a very attractive price, because you can see the long-term chart of this company. It's not going anywhere. It's going to continue to do this. It's up to you how much value you want to make out of this investment. So that's our approach to quality. Whether you've got Unilever, whether you're in Diageo, whether you're in Pfizer, whether you're in Johnson & Johnson, BP, Shell, Wells Fargo, these companies were around in World War II. If these companies can survive a war and still keep growing and still keep delivering for clients, all the more better, all the better. And also, what's quality? These companies paying their dividends, they're now no longer having to pay these dividends. There's a lot of political pressure on these companies not to pay a dividend. Right, well, these companies' balance sheets were solid gold before, and now they're not paying out dividends to investors for maybe a year, maybe half a year. That goes back onto their balance sheets, makes them even better shape. So there's a lot to think about. Every single threat in this market, if you turn it on its head and think about it in terms of quality, there is an opportunity there. There is an opportunity to buy long-term value. You just need to be pragmatic about it. I liken it to this. In layman's terms, if you saw that car sitting on the forecourt with a £6,000 price tag on it, you'd be jumping up and down, because intrinsically you know the value of a Ferrari. It's upwards of £200,000, and you're looking at it for £6,000, given it's an extreme scenario. But that would be a screaming buy, because you know the quality of the underlying asset. That's what we view the markets as these high quality assets, these Ferrari-like stocks continue to come off. We still see the product as high quality. So it's just more attractive pricing. So what I wanted to do is sum up this approach. And I know this guy gets talked about all the time, and we try to steer away from using him because everybody uses him. But to sum up what I'm talking about here, he's given two quotes. He's given many quotes in his life, but these two are applicable to what we're talking about. Price is what you pay, value is what you get. Just spent time talking about what we believe is value, what we see as value. And that's not going to change. By and large, we're taking an assumption here that these long-term companies are still going to be great companies at the end of this. Yes, there will be volatility and uncertainty, which will affect their balance sheets. But at the end of the day, these long-term companies that survived world wars are still going to be around. So that's the value. The price we pay is going to keep getting better and better and better if this economic sell-off occurs. So we understand what we're buying. That leads us on to the next quote, which is never test the depth of a river with both feet. Abundantly obvious, and you'd never do it. But that says to us, don't go in, don't time the market. Don't keep your capital and then just flood it in one go. Go, right, I believe it's now sold off to an extent that it's now attractive. Don't test the depth of the river with both feet. Buy a little bit, buy a little bit more, buy a little bit more. Take a pragmatic, repeatable approach that makes sense to you and your clients. That's what we want to do here. It's not time the market, but time in the market. Incremental investments of ever greater value. That's what we're looking to do here. Just a word on quality. I think a lot of people are talking about what the best things to own in this bounce back are. Just going back to what I was talking about earlier. In terms of equity investments, it's, as we've spoken about, it's high quality assets. It's assets that are going to be around when the dust settles. I think this dividend slashing that's being expected of companies is going to be a benefit. It's going to be essential for some. It's going to be a huge balance sheet strengthener for others. It's going to save some companies, which is going to potentially offset a credit crisis. So I think that's a huge opportunity there. But it's the long-term companies with tough, robust balance sheets with high barriers to entry. Those sorts of companies are going to be the ones that fare very well. That's your defensive play. You're obviously going to have companies and fund managers that take stakes in companies that will rebound off the back of this. Look at airlines, look at travel and leisure, look at retail, potentially, arguably even high streets. Those are going to be short-term bounces. And yes, absolutely, at the fringes, we can make an asset allocation towards those sectors to maybe enjoy that immediate bounce back. But I wouldn't say that they're going to be long-term investments. You have to think about both the short and the long term. In terms of other asset classes, precious metals, again, very, very good. That's for the defensive element. We've talked majority of the time in this presentation about the equity market, and that's where we think it's going. But in the interim, we need to keep buying high quality assets outside of the equity market. That very much remains in government debt is going to continue to be attractive. As central banks continue to pump stimulus into the market, those asset classes in terms of corporate credit, AAA rated credit, government debt, gold, silver, those asset classes are going to be very well looked after, very well bid as investors continue to buy them as safe haven assets. Property is one that we have stayed away from. Whilst property itself is a robust asset class because it's physical, the liquidity around it and the constraints that the FCA have put on fund managers, making it much easier for them to gate their product at the first sign of some volatility, makes us very nervous about liquidity. And at the end of the day, liquidity is key. We are stewards of capital. We do not want to be owning anything that has liquidity problems. Even if it's got an incredible upside, but it has liquidity problems, we don't want to own it. Liquidity is sacrosanct. And at the moment, the property market, especially in the UK, just doesn't stack up for us. I'm going to leave it there. Switch on to some questions from our favourite man, Trump. And over to you, Joe.
Brilliant. Thanks a lot, James. Guys, we've had loads of questions come through from you, so thank you very, very much. We'll try and answer as many as we possibly can. I'll try and sort of condense quite a few of them into one question for James. Any that we don't answer here, we will get in contact with you directly and send answers over to your questions. But what we'll start with is in terms of the markets, and Brexit has been a common question throughout. People asking how Brexit will impact on the market and any rallies that we could see. Do you foresee Brexit potentially slowing up any future recovery?
That's a great question, and it's one that I don't think is being asked enough, despite the fact that people are talking about it, is the kind of COVID-19 has taken over everyone's, it's occupying everything. All the headlines is COVID-19. Brexit's still there. Absolutely. We need to take that as a factor. I think Boris Johnson would be suicidal politically if he continued to push for a December deadline for trade negotiations. I would be very surprised if he continues to do that, and I'm actually expecting him at some point to come out and say that he's agreed with Europe to push that back, maybe indefinitely, maybe into 2021 at some point. I think it's going to give him time to ratchet back some of that more extreme language that he came out with at the end of last year after he'd had that big win. and maybe take a more pragmatic approach. I believe that will boost the UK market. I believe that will boost the 250. That will boost UK domestic companies. It will boost the pound. If that starts to come out when the economic news maybe has come through and we've had this economic bear market, earnings have been taken on, they've been swallowed, the market's reacted, Boris comes out with this news, I think it'll play very positively for the UK market. Let's remember that the majority of the 250 and the all-share rally off the back of Boris Johnson getting in was cut short, arguably, by the fact that Boris immediately said he'd want to put into legislation that the UK was going to have a hard Brexit or going to leave without a deal in December. So you can expect the lifting of that to maybe lift that market, lift that 250, those domestic stocks, as well as the pound. I would continue to believe that the FTSE 100 will be behaving counter to the pound. So when the pound strengthens, you'll see the FTSE 100 lag the 250, vice versa. It's understandable that the UK, well, actually, it's not understandable that the UK 250 has underperformed in this Corona sell-off. It seems like investors have very much flocked to selling down the 250 investment as quickly as they possibly can in this coronavirus. So, you know, the 250 was cheap before, it's even cheaper now. It was cheap to develop markets, it's even cheaper now. The pound has been sold off quite heavily as people have flocked towards the dollar in this COVID-19 sell-off. So, you know, there's a lot of latent value there in the 250, the domestic end of the UK market. So I would expect to see some outperformance from the UK under that scenario. And I don't believe that Boris is going to continue with his December deadline.
Okay. Quite a lot of questions on cash levels and entry points into the market. So I'll try and sum up in form of a question. What are the cash levels looking like across our portfolios, and what is our plan to deploy cash into the market, and how does that compare to pre-COVID?
So again, good question. Cash levels are elevated. That's been welcomed by the clients that I've spoken to. Cash levels haven't been elevated recently. Cash levels were elevated at the start of this sell-off. You know, as early as the 20th of February, we were selling clients' investments in the equity market into cash, not reinvesting them. Obviously, different cash levels depend on what asset, what risk model you're invested into. I would say the figure rests at circa 15% cash levels to 20% cash levels. We've retained that balance, and we intend to recommit that back to the equity market, again, in the manner that we've discussed at this presentation. Cash levels are high, as they should be in this type of environment. Cash, as they say, in this type of environment is king. There is no asset class that will generate you that level of return, which is to say zero, without any volatility or risk at all. It allows us to capture that market at ever increasing levels of value. So we're very happy with the cash levels that we have. We're very excited at the opportunity that affords us. We would much rather have this than be fully invested all the way down and then have to remain fully invested all the way back up. This allows us a lot more tactical flexibility. So yeah, 15%, 15 to 20%. It is a lot higher than it has been historically, and I believe it should be in this environment. And we're very excited about putting it back to work.
Brilliant. James, another question that we've got here is, you talked quite a lot about quality and consumables. These haven't tended to fall as much as the rest of the market. The question is, will consumables show the same sort of recovery as value stocks moving forward?
I think from here, if we can, let's use the framework that we've been discussing, that the market's going to go lower from here. If you're invested in those consumable, high quality stocks, let me bucket them up for a second and say perhaps Terry Smith. those high quality assets that some of those fund managers are buying will outperform on the way down. They will continue to be defensive. They will continue to be what everyone wants to own because they're going to be around when the dust settles. Now, for a recovery back, if they've outperformed on the way down, I'm going to be extremely surprised if they outperform on the way up. But what are we talking about here? Are we talking about outperforming in the immediate rally back, or are we talking about the next 5 to 10 years? Because in the immediate rally back, your airline stocks, your cruise liners, your retail, your restaurants, your leisure will likely rebound potentially on a positivity returning to the market. You'll start to see those stocks rally back because they've been sold off harder. I mean, that's one of the ways that the markets work. Do I believe over 5 to 10 years that those stocks will continue to rally and rally and rally? No, I don't. So I believe that they will underperform for the first part of the rally. Then I believe they will take over as that quality starts to shine through and people look at long term what they want to start owning. So again, going back to what we want to own, yes, it's high quality, but we want to make sure that we have a spread of investments across what rallies back in the short term, as well as the high long-term quality, which would be the stocks that you're talking about. I hope that answers your question.
Certainly. I think in the interest of not taking up too much time, we'll limit this to just 2 more questions. Again, any questions that aren't answered here, we will come back to you directly and answer those. A lot of questions about ESG investing. Do you think this is the current market conditions are going to affect ESG investments and the appetite for such investments moving forward?
Absolutely. Another great question. Loving these questions. ESG is outperformed on the way down. Investors have been more confident about owning ESG related stocks than they have been non-ESG related stocks. That tells me a huge amount about the appetite towards ESG investing. A company that has an ESG framework that adheres to ESG principles, that upholds ESG principles, is a fundamentally more attractive company. It has a better balance sheet, it has a better governance, it has a better board, it has better pricing control. It's a more attractive company. So therefore, they've outperformed on the way down. I believe that the growth prospects for the ESG market as we continue in this world, and nothing like COVID-19 is going to remind people that we need to look after this planet and we need to be stewards of it, is going to push the ESG market higher. I believe actually in the future, maybe not in the next year or 2, but the ESG market will cease to be, because the ESG market will become the market. Every company, or the majority of these companies that we currently buy and sell and trade on the global stock market, will all become ESG governors. They will all become ESG champions, because they realize that in order to have a proper rallying stock and compete with your competitors, you need to be implementing these policies. So I believe it's going to be a strange one for ESG because it's so attractive, because it actually makes sense from a corporate perspective. It's going to just get bigger and bigger and bigger.
Brilliant. Lastly then, for the questions, this has been asked quite a lot. People are quite interested to know what our performance has been across our portfolios in Q1.
Okay, so the performance obviously differs depending on what risk profile you are at. The performance at the top end, which is almost entirely the equity market, is understandably going to be a lot bigger than the performance down at the defensive end, which is almost non-existent when it comes to equity investments. The performance has been ahead of the benchmark, which is the FTSE All-Share and government debt. We've had elements of the portfolios which have been adversely hit because they have a little bit more of what's been affected. We have a huge amount of quality ballast or quality stocks that we like to call them. They ground the portfolios. So that's really helped bolster the performance. So it's been slightly ahead of the benchmark. We would like it to be more, but we think it's market beating. We've looked at a lot of our competitors and we've managed to outperform them down at the defensive end and down to the middle range end, where you've got a balanced proportion of equity and fixed income. What I'm really positive about is the level of pullback in the client portfolios has been less in a lot of the portfolios than we made in 2019. 2019, whilst it was a good year for markets, it won't be remembered as a historic year for markets, especially when you view it against COVID-19 2020. For us to have lost less in the first first bear market in 11 years than we made in 2019 is a big feather in our cap for us. That's defending capital. That's being stewards of capital. That's ensuring that the client's long-term client gains are still intact. That's what we're here to do, is we're here to protect capital on the way down and invest it appropriately on the way up to capture as much of this market. So yes, the performance has been good. If I had a crystal ball, had hindsight, we'd go back and make changes, but we're very happy with what we did. We're very happy with our first mover advantage in selling equities almost on the 20th of February, which is when the sell-off started. We removed 5 to 7.5% of our equity position. So we're very happy with that. And we remain very excited for the future.
Brilliant. Thank you, James. I think that's going to do it for now. We'll wrap it up there. There are a few more questions that are a bit more intricate that we will get in touch with you as soon as possible with answers on those. Worth mentioning again, or reiterating, I should say, that this is going to be the first in a whole range of webinars and webcasts that we're looking to do moving forward. We're going to be very much driven by your feedback and any sort of votes that you put forward to us. The vast majority of you have voted for an ethical/ESG investment-driven presentation next. So we will look to get that out to you guys as soon as practically possible. We're branding this under the TAM Talks banner. So you'll be seeing a lot of TAM Talks moving forward, especially in the circumstances that we're currently living in, where face-to-face meetings are very much out of the question. These slides are recorded and they will be available for you to sort of forward on to any of your colleagues moving forward. We'll also send a copy of the slides moving on from this as well. Please do fill in the feedback, because again, this helps us know in areas that we've gone wrong, that we can improve on, or that we've done well in. James, thank you very much for taking the time to go through this with everybody. And finally, to the audience, thank you very much for dialing in. We really do appreciate this, and we look forward to getting in contact with you very soon. Many thanks.
Thanks, guys.